Right. So now this will be mentorship day one for this month, for the month of June. We're going to be speaking about the same stuff again: order flow, market structure, and instead of Wyckoff, I'll change it up to balanced price ranges and N30, right? So I'll make N30 public as well, but liquidity cycles will be private because you know why, right? So when you pair liquidity cycles and N30, that is where the true combination is. So if you are only left with one, you can't do it. You can't do anything about it. So you need to attend the days in which we are going to be speaking about liquidity cycles in order to use that understanding with N30. All right. Okay. Order flow. So where do we start with order flow? So now, when we look at order flow, right, it's like a refresher for everyone. When we start with order flow, we understand that order flow is essentially the flow of orders, basically, right? So in this case, we have buys, buying happening, or we can also say that this move over here, right? This move over here has been caused by a relatively large transaction that has taken place in the market. So that transaction is a buy. Okay. And it's not just a small buy, it's a buy amounting to around, let's say, $5 million, right? Something like that. So that is order flow. So when we have a transaction in the marketplace, right, which is large enough to cause a price displacement, that is when you have a certain order flow in a certain direction. If a large corporation, let's say if a large corporation came and they have to, like, pay a bank, they have to pay a bank around, let's say, $10 million, right? If they have to pay a bank $10 million, so essentially they are buying one currency, right? They're buying one currency, right? So when they buy that currency to pay the bank in another country, right, that's when the large order comes in. So when the large order comes in, we understand that, okay, order flow is bullish, right? Order flow is bullish. Same thing for the other side, bearish order flow and bullish order flow, right? They have the same concepts behind them. Now what can we use to identify order flow and bias? Okay, that's the problem. What can we use to order flow, to identify order flow and bias? So now that part we are going to reference Mr. ICT, right? So based on Mr. ICT, we have, or what I'm going to focus on is, number one, we have premium and discount, right? We have premium and discount. Then we have uh, the PD arrays, and then we have the entry techniques, right? So let's say breakers, which are the most highly probable ones. So breakers, fair value gap, order block, rejection block, and we can say mitigation block also, right? So we have all of these. So we have all of these, and these are the main things that we're going to be concerned about. Now we're not going to be looking at so many different things at once, right? We're going to focus on the ones that actually matter. Having too much information will also lead to information overload. Okay, so let's start off with premium and discount. So when we speak about premium and discount, right, usually if you look at the retail side, retail people, they would try to buy at premium, sell that what you call discount. Like, for example, Raja banks and all of the traders that trade like Raja banks, right? They have levels. They have levels like this, right? Actually, not like this. They have it like this, right? So I have it like this, and now they have it like this. So now what they do is, now mind you, right? Now we know that this is premium discount, right? Premium discount. Now if they sell over here, good, that's correct, but they won't do that. What they do is they do this. They draw these pseudo levels and they go like this: potential buys above this level. Okay, potential buys above this level, and then what happens? Okay, let's just say, for example, this level here, potential buys above this level. Okay, fine. Then what they do is they keep their buy stop here, keep their buy stops here. Their stop loss is something like this, and what happens? They lose. Why? Because they bought at premium, and that's the wrong thing to do. And that's the wrong thing to do. So what we need to focus on is always understand the range that we are working within. Okay, understand the range that we are working within. So by understanding the range that we are working within, we are able to filter out sells and buys. Right? We are able to filter out sells and buys. So this would be premium, this would be discount, right? Premium and discount. And so that's basically the only thing that we need to understand, right? That's as simple as we can get. We want to buy at a discount, we want to sell at a premium, and there are certain areas in which we can accurately apply this concept. It's on the daily time frame, 4-hour time frame, right? When we have to draw out our PD arrays. Okay, because now if you think about it like this, let's say this is a 4-hour range. Okay, 4 hour range. This is your premium, this is your discount, so this is your equilibrium, right? Equilibrium. Now let's say you have a clean order block here, and you have a clean order block here. Price will come down. Yes, you will get a reaction here, but will we see a high being taken? No, because more we understand that most of the transactions, like most of the orders will come in at discount, at what the central banks and what corporations deem to be cheap. So with relative to this range, any price below this equilibrium point here is cheap, and they buy to go up. When they buy to go up, this is when we see a large displacement in price, and this large displacement in price is seen as liquidity voids. Okay, liquidity, and we're going to speak about that as well. So liquidity voids, and it seems like I missed the cell I was looking for. It's fine. Okay, so liquidity voids and liquidity void. Okay, so when you see these liquidity voids, they are essential in your in understanding that, okay, a large order has come into the market, so price is going to go in this direction. Okay, when you see a liquidity void forming, that indicates a momentum shift, right? And the momentum shift, we'll speak about that tomorrow, and on Sunday as well. Okay, so anyways, back to premium and discount. So when we look at premium and discount, always remember we want to sell at premium and buy at discount. Okay, and this will also help you understand order flow. All right, so now if you look at the 4-hour chart, let me take one that does not have a thing. So this one maybe. Okay, hold up. Right. So now if you look at order flow, okay, and if you look at the 4-hour chart, and if we just take it from here to here, okay, so last week we were working within this range, and on this week also we are working within this range, right? So within this range, buying below here was perfect. As you can see, it went up, right? And selling at premium was also perfect, because you don't buy at premium, you want to sell at premium. So when you find yourself at premium, right, and when you want to buy, you want to buy with very, very, very short-term targets. So maybe this high, and stop, right? Now, if you had bought somewhere here to target the 1.2 to the 20 level over here, you would have been utterly destroyed, right? You would have been utterly destroyed, because why? Premium, discount, simple as that. All right, so then moving on, does everyone understand this? Not does everyone understand, does everyone get it so far? Yeah, right. Let's put it on the chat box so I can move on. Yeah, okay, righto. Okay, so then when we look at understanding order flow, okay, so okay, we know that, okay, when we're in a range, we want to buy at discount, sell at premium, and not the other way around. Then how to identify the certain signatures in price, that gives us a signal that, okay, this is going to shift order flow to bullish, this is going to shift order flow to bearish, right? How do we find all of that? So that comes to ICT's PD-array matrix, right? It comes to ICT's PD-array matrix. So now, when it comes to ICT's PD-array matrix, we have the ones in premium and the ones in discount. So the ones in premium is, call it P and call this D. We have, starting from the bottom, we have mitigation block, breaker block, liquidity void, fair value gap, what's up in fair value gap, order block, rejection block, and old high, right? So old high. And same thing reverse for discount. So we have the discount mitigation block, breaker block, equity void, fair value gap. After fair value gap, you have order block, and after order block, you have rejection block. Rejection block, you have old low, right? So now the way in which these get used is that if if price is approaching a level, okay, if price is approaching a level, and if it does not, it like, let's say coming down from here, right? If it does not encounter mitigation block, it will go lower. If there's no breaker block, it will go lower. No liquidity void, it goes lower, and so on, right? Until it meets one of these guys. And once it meets one of these guys, this is when you see a big displacement up. Okay, and same thing apply to the other side. Okay, then will you buy at in premium at some special scenario? Or you never buy in premium. Okay, so I always when we look at buying and selling in when we look at buying in premium, right? I would never buy, let's say for Euro USD, if you're in premium, I would never buy for more than 20. No, I would never buy for more than 10 pips. Okay, that's because it might not even go beyond that, right? That's like super risky. But if I was in discount and I bought Euro USD, yes, then I would go for 20, 30, 40 pips, right? So the pip count that you can achieve inside of the premium region and discount region are completely different, right? So like what discipline says, yes, it's low probability. All right, so okay, so old high, blah, blah, blah. We have all of this, right? So if price does not encounter any one of these, it will keep on moving until it finds something, right? It will keep on moving until it finds something at all. Okay. Now, what or how do we classify highly probable? Okay. How do we classify highly probable order blocks, fair value gaps, breaker blocks, and all of that? Now that comes from Mr. Chris Lowry's, right? Mr. Chris Lowry's concept of a liquidity void. So that's not ICTs, that is Chris Lowry's, right? So liquidity void. Okay. Now with this liquidity void given by its name, we can at once say that, okay, there's something missing inside of it, right? We know that there's something missing inside of it. So once we know that there's something missing inside of it, we need to ask ourselves, okay, what is missing, right? If you look at this from, let's say, over here, right, over here, if you look at the high, not the high, the swing high on that we can find on the lower time frame, here, here, right? This entire thing is a liquidity void. Okay, this entire thing is a liquidity void. Now what it does, okay, what it does is provide, in this case, this one provides only buy side. So what ICT calls, what ICT rebranded as buy side imbalance, sell side inefficiency, and this one over here is sell side imbalance, buy side inefficiency. Okay, sell side imbalance and buy side inefficiency. Now you can see, and this part I'm going to further elaborate on Sunday, right? You can see that price over here stopped at a certain region. So draw this out here and here. Now this is a fair value gap. Okay, this over here, let's say something like this, right? Something like this is not a fair value gap. Okay, a fair value gap is an inefficiency, okay, which shows the either a liquidity void which is bearish or bullish, right? And the defining factor of a fair value gap is that one of the candles, right, should show a delivery of the opposite counterparty. Okay, one of the candles should show delivery of the opposite counterparty. So now what this means is, right, if we are coming down, if you're having a bearish liquidity void, this is a bullish, this is bullish, right? So this is your buy side, this is your sell side, and inside of this candle here, this one is also buy side. Okay, buy side and sell side both. So when we look at a wick, something like this, let's just take that as an example, right? And if you break this down to a lower time frame, okay, if you break this down to a lower time frame, this is actually something like this. Give me a second. It's actually something like, hold up. Okay, so it's actually something like this, right? There are candles going up, and then we have equal amount of candles going down, or with equal volume, it's going down. Okay, with equal volume, it's going down. So this over here, from the left side is your buy side delivery, and from the right side, it's your sell side delivery. Okay, left is your buy side delivery, right is your sell side delivery. So then when we have a scenario like this is your fair value gap. Okay, this is your fair value gap. And when you have scenario like let's say over here, now look over here, right? See where price reacted. Okay, see where price reacted. See, this is buy side imbalance, sell side inefficiency. This is the bearish delivery, and this is also a bearish delivery here. Okay, bearish delivery also over here. Because why? Because we have the left side is sell side. Now for a bullish candle, the left side is sell side and the right side is buy side. For a bearish candle, okay, for a bearish candle, like what I just showed you earlier, the left side is buy side and the right side is sell side. Okay, left side is buy side and right side is sell side. Why? Because it goes up and then comes down, and this one it comes down and then it goes up. Simple as that. Okay, now you see here we got the reaction. Here we got the reaction. Why? Because you have fair value gap. This is a fair value gap. Okay, this is your fair value gap. It's not just any gap that you see. Okay, it needs to be paired with the liquidity void. And if you see something like, let's say if you see a price reacts over here, okay, if you see a price reacting over here, that's because, oh, on this time frame this is a liquidity void, but on the lower time frame it can be seen as a fair value gap. See, buy side delivery, sell side, this is a fair value gap. Okay, so that's what you need to understand. So this this will naturally come to you with practice on the chart and pattern recognition and all of that on a daily basis. Yeah, most of the PDRs come from 1 hour, 4 hour, and all that. That's the ones that cause the big movements. And it is N30. It is N30 that causes the big expansion. Like today, I said in the Discord group, right? I said when we look at red news events, okay, when we look at red news events, the direction, okay, the direction and the liquidity pool that is going to get tagged for the day is already determined. Okay, it's already determined. Now you see, if I show you this one here, we had red news, right, for UK, which provided some liquidity for euro also, and then we had this one here at 10 o'clock, so which is still incoming, right? It's on the way. So we have this. So now this here, this event here, coupled with what we can see over here, right? If I would say, if I'm right, right, but today it caught me by surprise, so that's why I'm saying if. So if I'm right, this next news event or the next N30 will cause price to plummet down and take out the sell side target. Okay, will cause price to plummet down and take out the sell side target. So that's what I'm basically looking for on Euro USD tonight, and it's also the end of the week, right? So that's what I'm going to be looking for on Euro USD, right? So then, so I took a sell. Let's see what happens. If I'm wrong, it's fine. Demo. Okay. Anyways, where were we? Quick question: if price would go up, would you expect it to go to the 30-minute fair gap or the 1 hour low on the left? Wait, let me check. Let me check. On the left, okay. So 30-minute fair value gap would be this one and this one. This is the fair value gap, and oh damn, too bad. Okay, so anyways, this is the fair value gap, right? And you can see that price is already filling it up, right? So price has to fill it up by coming just a bit lower. Price will come a bit lower, and we can see that fill. So once we see that fill, right, we should be seeing some form of reaction over here. Oh wait, fair gap at 12 o'clock. Let's have a look. 12 o'clock here, right? Is this what you're talking about? So where's the fair value gap at 12 o'clock? Right before 6 o'clock. Right before 6 o'clock is this is 6 o'clock. This is the fair value gap, right? This one. Okay. Yeah, this is the fair value gap. Right. So when price comes up higher, and now you see on this time frame it's a on 30-minute time frame it's a fair value gap, right? I lost. Okay, anyways, on this time frame it's a fair value gap. So then if you look at the 1 hour, right, on the 1 hour, we can see that it's also a big fair value gap here, right? So then what makes it highly probable is that this entire move down, right, caused a break in market structure, which is again something we'll speak about tomorrow. Okay, but for now, I mean, since like let's not confuse the different things. For now, let's just focus on identifying how it actually looks like, so that we can go through this much more in a much easier fashion, right? So that's basically how the fair value gap works and how it should look like. Okay, how the fair value gap works and how it should look like. It's just not any gap like that. So if it is any gap like that, then on the lower time frame you would see something like this, like we just saw on the 30-minute time frame. You will see there'll be an OB and then there'll be the gap. Okay, so those are the highest probable fair value gaps. All right, then when we look at how we can identify what is the most highly probable spot. Okay, what is the most highly probable spot? That is when, if you look at, let's say, Bitcoin has a lot of movement, right? So, okay. Oh, nice reaction here. Okay. Right. So when we look at something like this, the highly probable spots. So the highly probable spots would be something that is coupled with a liquidity void, right? Something that's coupled with a liquidity void only, not a fair value gap, liquidity void. Okay. When we look at an order block or this last buy side delivery, yes. If there is no fair value gap on lower time frame, higher time frame fair value gap is valid. Yes. Okay. Now, when we look at the highest probable PD arrays, right now, just think about this, right? The highest probable PD arrays, right? So we call it the highest probable PD arrays are the ones that are the ones whose market structure has led to a market structural break. Okay, are the ones whose market structure led to a market structural break. Okay, so meaning this led to a break in market structure, right? This led to a break in market structure. So leading to a break in market structure, we can expect this area here to be sensitive. So now this is the 4-hour chart, right? So it was quite sensitive, if you can see. So the sensitivity led to about $2,526, right? So it dropped by 256 pips, maybe. I don't know how to count this in crypto, right? So it dropped a lot in terms of a day trade. Okay, in terms of day trade, it dropped a lot. So now the point I'm trying to make is, right, whenever you see market structure that has led to a market structural break, so break, right, the point of origin, right, will have a very high probability, okay, will have a very high probability PD array. So we can see that you have this here, and this here, right? So last buy side delivery here, and you have a inefficiency here. So you can see that what is this? Fair value gap. So fair value gap has been filled and price is coming down. Fair value gap has been filled and price is coming down. Okay, so that's what you need to understand. Just need to understand that if there is a BMS, then PD array highly probable, right? That's all. When you have a break in market structure, the PD array in that market structure is going to be a highly probable PD array. So now when a PD array is highly probable, right? That means we should anticipate that reaction, and from that reaction, we should see price go somewhere. Now, this is where the next concept comes into play. The next concept is the concept of ICTs concept, internal to external and external to internal range liquidity, right? Internal to external and external to internal range liquidity. So if you have internal, which I call I, and external, which I call E, and then you have E to I. So internal range liquidity is everything in the PDRA matrix apart from the old highs and lows. External range is only highs, lows. And then we go from the same thing here. Okay. Internal to external, external to internal. Okay. Internal to external, external to internal. Now keeping this in mind, if price then reacts at a highly sensitive area, which is this one, right? Where will price go? Now this is internal range liquidity, right? So where will price go? Price might come number one here. This is external, and if the bias for Bitcoin is still to the downside, then here and here, they are all external. They are all external. But now you can see that this run up, right, this liquidity void here led to a market structural break here. So what does that mean? That means that when price comes down, right, when price comes down, you will see uh, a reaction from here. Okay, you see a reaction from here. Why? Because we broke market structure here. We broke market structure here, kind of. Yeah, we did break it. We wicked through it, and it's coming back down. Now, why is it coming down? So you see, when it comes to market structure and order flow, right, it becomes a very tricky thing because now we have some people saying, okay, my bias is right, but my trade lost, and at the end of the day, it after I lost, it ended up going in my direction, the direction in which I was anticipating price to go in, right? So if we have scenarios like that, you need to look at the overall structure. You need to look at, are we bullish, are we bearish? Now, this break in market structure here, here, and here, right? When we see this, we can see that, okay, overall market structure is bearish. So we can sell over here and expect it to come a bit lower. And then at the same time, you can see that, okay, we have a break in market structure here, we have a break in market structure here. So then what? Then this will be a sensitive spot, right? So then what we can reasonably infer from this is that when price comes here, right, we will see some form of a reaction back up here and lower. Okay. Now you might then ask, but then you just said internal to external and external to internal. Yes. But at the same time, that also works based on the overall prevailing order flow, right? Now remember, when we look at the prevailing order flow, that means now if I just delete these temporarily, if I look at the weekly chart and look at this, right, came down on the weekly daily chart, and now if you look at this, right, we came down, broke market structure, rejected without going back inside the range, came lower, never tried to go higher than this, lower, lower, and now it's trying to go higher, right? So then we also have this side. This side we have breaking market structure, breaking market structure, breaking market structure, and then we have a reversal. We have a reversal. Okay. Then you might say, overall, we are bullish from this side, but from this side, the market structure is telling us otherwise, right? This side, market structure is telling us otherwise. And we have zero reference point in Bitcoin. We have zero reference point to the left at this price, right? To say, okay, wait. So if it's just reacting over here, it should react for a reason. Are we going from internal to external? Are we going from external to internal? That we don't know for Bitcoin, right? For Bitcoin, we don't know that. So now this is where we can apply the concept of premium and discount. So if you just zoom out and now look at where price is working with it. Okay. Okay, where price is working within. Now see, price is working within this low, this high. All right, so this entire thing. So it's based, if you just draw it out, it just looks like one big thing like this, right? One big thing like this. And if you then consider all of the people that have bought Bitcoin over the years, they would have their stops. If they have their stops, they will have it here, here, here. So they are taken out. They have been taken out. These people are yet to be taken out. Right? These people are yet to be taken out. So what's happening in Bitcoin right now is a search for liquidity, right? In order for the central banks and hedge funds, mutual funds, for all of them to start controlling cryptocurrency as well, right? It's all for that. That's why we are seeing this big move. So in order for them to control cryptocurrency like this, they need to take out existing positions and accumulate these positions for themselves. And so how will that happen? That will happen via taking out these stops over here and entering at a spot where it's very obvious. Okay, entering at a spot where it's very obvious. Then if you look at the weekly, what's the obvious spot? Somewhere here. Okay, somewhere here. So that is basically what I'm looking for. in Bitcoin, right? And also this is basically how you should be looking at order flow. You should be looking at where is it coming from, right? So we just bring these things back. Wrong stuff. Okay. Right, we should be looking at where it's coming from. It's coming from here. Did it break market structure? Yes. After it breaks market structure, can we anticipate a reaction from closer to the origin point? Yes. Did we get the reaction? Yes. Okay. So these are all questions you need to ask yourself. You just don't go into the marketplace blindly buying and selling. Okay. We have, if you guys are new, and if you check the Telegram group, there I have sent some PDF files in the past. I think 1 or 2 months ago, where I said there is always a reason for every price move. Okay, there's always a reason for every price move. There's always a reason. The initiation of one side, like for example this one, there's always a reason that this will go up and take out a high, take out a high. There's always a reason that this will go down and take out a low, right? There's always a reason for a high or low to be taken. And if you know that reason, you can trade up and down seamlessly. Okay? Is everyone on the same page? All right. Okay. Uh, then we are done with premium and discount. We are done with PDRA matrix. Then we need to look at uh, what are the highly probable combinations. Okay, now this is pretty simple. So there are highly probable combinations. You can see that we have a bearish order block here, liquidity void here, broke market structure. Now reference what we were just speaking about. It broke market structure, came back to the origin, and what did it react from? Bearish order block. So that is internal range liquidity. Internal range liquidity goes to external here, right? External. And from this point, this range broke market structure. So this bearish order block is sensitive, and as a result, price is coming down. So where will price go to? Here. So from here to here, it's done. Here to here, it's done. Now this is the current profile from here to here. This is what Euro USD is doing, or all the Euro futures contracts are doing, right? So basically, what I just spoke about is a live example. Okay. Now, what are the high probable combinations? Bearish order block, liquidity void. Bearish order block, liquidity void. Bearish order block, liquidity void, kind of, which leads to always, right? Always leads to a break in market structure. Okay. All of these liquidity voids, all of these moves must lead to a break in market structure. If they do not lead to a break in market structure, guess what's going to happen? Sideways market. See, came up, down. Did it break any market structure anywhere? No. So it will react over here, going higher here. Did it break market structure? No. So you buy somewhere here, go higher. Okay, now it broke market structure here. Okay, now once breaking market structure there, this is suspect, right? So you look to the left. What is that? Let's see what that was. Here, right? This is uh, bearish order block. Right here, bearish order block reacts from there, and fair value gap also reacts from there and then comes lower, right? So we need to look at all of those. Don't just blindly look at the market, okay? So liquidity void and bearish order block, rejection block, whatever. If anything is paired with a liquidity void, that is a highly probable scenario. Okay, highly probable scenario. And the times in which they will not work, the times in which they will not work is when you are looking at order flow all wrong. And what I mean by that is, we always start off our analysis from the weekly, daily, and 4 hour, right? If we can't identify, if you can't identify what the weekly, daily, 4 hour order flow is, right, then chances are you're only going to get lucky in the lower time frames. Okay, you're only going to get lucky in the lower time frames. If you understand what the 4 hour, daily, weekly order flow is, right, that is when you can truly get in sync. So that is when you can understand that, okay, price went up here and now you see price dropping, right? It just dropped like that. So when it drops like this, where did it react from? Bullish or a block, right? My computer is being a bit laggy. Hold up. Okay. Yeah. So bullish or a block reacted from there. Price goes higher. And now looking at this point. Okay, looking at this point and this point. The dollar index shows a reversal. So when the dollar index shows a reversal, everything switches up, right? So that has something to do with the correlation between the markets. So you have dollar index, Euro USD, right? Almost a mirror image of each other, almost. Okay, this goes up, this guy goes down. This guy, obviously, you guys know now. This guy goes down, this guy goes up, right? So now this guy goes down, meaning dollar index is going up, right? Dollar index is going up. So if we now look at this bullish order block here, run up here, this is essentially one large liquidity void on the higher time frame. Okay, large liquidity void on the higher time frame, and prices reacts over there. Good. And from this point here, it was due to a reversal on the dollar index. So if it was a reversal on the dollar index, existing members know that this has also something to do with the bond prices, right? So bond prices, dollar index, and then only we get forex, right? So this goes up, this goes down, this goes up, something like that, right? Okay, so that's pretty much it regarding premium discount, the PDRA matrix, coupling the highest probable PDRAs together, right? So just as a way of remembering it very easily, just think of it like this: liquidity void plus PDRA equals high probability. Right, now I'll show you another example now. This is a high probability. Okay, liquidity void plus PDRA is equal to high probability trading. Then if you look at the Nasdaq yesterday, right? Yesterday we have 4 hour plus liquidity void. Yes. By the same time, we look at dollar index. Dollar index not yet there. Okay, Nasdaq. Nasdaq. Yesterday we had this solid trade yesterday from here. I believe, no, I took it from here and here, right? So now see, liquidity void, break in market structure, high probable entry point here, and price went higher. So this leg here broke market structure. Where did it break market structure? It broke market structure here, here, and here. Now why here? It's because if we know how a swing high and low actually forms, we know that they have a 3 bar pattern. The 3 bar pattern is this one and this one. So this one would be 1, 2, 3, swing high. So break in market structure. So then this becomes a high probable area. So what's inside this high probable area? We have order block, and price reacted, goes up nicely and stops at around 13998, right? So 13998, so that is near rejection block on the daily time frame. Let's see if I'm right. Yes, here you go. Rejection block on the daily time frame right here. Okay, now looking at this over here, we have another swing high a clean break, we should see now it's NYSE open. We should see something like this. Because anyway, yesterday's trade, I wanted to hold it until here, but I wasn't confident in keeping it overnight. But anyway, it panned out, so that's good to see. So this is what I want to see. I want to see take out these equal highs right over here. Okay. So anyways, this is a perfect example of something that makes a clean break with a liquidity void. Swing high here, swing high, nice break, comes back down into the origin point of the break, which is this, and price goes high. And at the same time, we also have a rejection block as well. So both together, if you just overlap them, you can see a nice refinement of the entry. Okay, right. That is all. So we have we have premium discount, PDRA matrix. Then we have high probability stuff, combinations. Sorry, probability combinations. And then, do you guys want me to show you breakers, mitigation blocks, or do you guys know that? This, some of you all just tell me, do you all want to see breakers, mitigation blocks, or are you all okay with everything? Sure, sure, okay, right. So, uh, okay, breaker blocks, right? So breaker blocks, you know that when price comes lower, makes a lower low, and then we make a break in market structure. So this over here needs to make a break in market structure for this entire thing to be valid, like I just said. So again, this is a pairing of liquidity void and a particular signature in price action, right? So you can see it over here also. So here you go. We have low, 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 break, and so after the break, price comes back down here. That's not straight, right here. Price comes here, and this entire region over here becomes the breaker. Okay, this is your breaker, and price goes lower. Sorry, goes higher. Now see, if you look at a breaker, right? So this is the first bar on a low higher time frame, second bar on a higher time frame, third bar on a higher time frame. Now do you see the relationship between all these fancy names and a swing high and swing low? Okay. Now if I complete this drawing, okay, if I complete this drawing, you can see that what does this show? This shows the three bar pattern, right? One, two, three. So we are essentially entering at the third bar. Okay, we are entering at the third bar to go higher, and this is what ICT calls an institutional swing point. Swing low, swing high, swing low. Oh, guys, looks like my trade idea for Euro USD actually panned out. So let's see whether we can take a trade. All right. So, anyways, you can see that when we look at a swing high and swing low, right? You know that we have this. Okay. So then the defining factor between a swing high and swing low is that the swing high has a higher high to the left, right? Higher high to the left, and a swing low has a lower low to the left. So these are the defining factors of a breaker block, right? So now if I look at this over here, uh, if you were to take a sell, right? Now we know that looking at this, we have this swing high here, this swing high here, and price just breaks down. Okay, prices break down. So then we know that if we enter somewhere here, it should be okay. Why? Because this will most likely make the next bar. So bar number one here, bar number two here, bar number three here. So this one, like that. Okay. So then let's see if we can get it in. I lost the earlier one, so I cut the risk in half. See if you can get it. but this is not a high probability session since this is not London close yet. So let's see what happens. Okay, so now look guys, the way you can be very confident about your trades, right, is when you understand that it always is, right, we always enter a trade, and when it always works out, if you zoom out and see when it works out. Now if you look at today's trade, right, all the way down, look at this. From here you can see that we have one first bar here, second bar here, third bar here. Now this is a bigger one, right? So now this is what we call a, this is the 1 minute chart. This is a short term high because it's on the 1 minute chart. Then if you look closely, you have one, two, three, one, two, three. Okay, one, two, three. So you can, looking at these 1, 2, 3 patterns, you can see that every time we make a higher high and it breaks down, the next one will be lower than the middle high. Okay, the next one will be lower than the middle high. You all, are you all with me? So this is like everything broken down, right? So do you all get it so far? Let me just open up another chart on the other side, on the other computer. Okay, check the chat. Yes, okay. So you see, it's always it has to do with the exercise you gave us, right? No. This is just showing the uh, foundation of a breaker. Okay, a foundation of an institutional swing point. Okay, once you understand institutional swing points, right, it will help you later also, but it will also help you with just normal entries as well. Okay, so now look at this. We have this, and then if you just move on lower and see exactly where the next expansion happened, right? You have swing, 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 right? And then what happened? Lower, goes down, right? Then you have again swing, swing, swing. So basically, what I'm trying to say is when you see that higher high make being made, and when you see this aggressive move down, somewhere here will be your third swing point, or the final bar that makes this a swing high, and then from there that's where you enter, and that's where it goes lower from. Okay. Then if you look at, I'd say another one. I believe I took a trade right earlier. The one I took a recording of. I took a recording of it over. I can't remember exactly. I think it was somewhere here. Okay, this it's fine. So look at this. You have get a pen. You have one, two, three, and now look. I said it's gonna. I said the next swing point right will form within here, and so it forms within that. So now what is that? You have liquidity void, and what's the high probable this thing with the liquidity void? On block. Here you go. Just touched with the pip and dropped. Okay, so I hope this is eye opening for you. If OB plus breaker in the same price, will it be more effective? OB plus breaker, you mean? Let's try to find an example. I think I get what you mean, but let's see if we can see an example. OB plus breaker. So basically something like this is it. Say we have one, two, three, or maybe the three is happening now. So then we would be looking at this area. Yeah, so something like this, right? Yeah, it should be more effective. Yeah, it should be more effective. But if the order flow has complete, like let's say the chances of losing, right? The chances of losing over here are still there because we are trying to sell at discount, right? But if this were to hold, then it should hold within somewhere here. Okay, and now see, okay, now here, now look, now this is the best part. So you see that we have how can I put this? We have a swing high here. Okay, so one on the lower time frame, 1, 2, 3. So once we make a swing high and that swing high breaks market structure, which again we'll speak about tomorrow, you see that it's a high probable entry point. When it comes somewhere here, it will just fall off. Okay, as assuming order flow doesn't change. Okay, so anyways, swing highs and swing lows, that is exactly how it's been done. Now, if you look at a buy side scenario, a buy side scenario would be over. Let's see, when did we have bullish order flow last? We had it today, right? So yesterday, I mean, somewhere here. Why doesn't this show? Right. So, anyways, we have, see, you have one wrong candle, 1, 2, 3. Okay, 1, 2, 3, and you see, we should then see the reaction happen from here. So this is the breaker, right? This is the breaker. Then you have uh, let's have a look again. This is a bigger time frame one. So we have here to here, sorry, here to here, breaker. Then you have different, it happens in different spots, and obviously the lower time frame we're looking at, the if the effect of it and the duration of it also changes. So we have a break over here, price goes up, tags this, comes down again. So again we have so many, we have this pattern showing every day, right? So the moment you see okay, it's a break, I'm going to take a buy or a sell. So you have 1, 2, 3, 1, 2, 3, right? 1, 2, 3. Did they react a bit and then it dropped off? Okay, so you using the bullish breakers, bearish breakers, they should be used also with prevailing order flow. Okay, so you can see after that it just dropped, and that was today. Yeah, so it was today. We had this one here, you had this one here, you had this one, you had this one over here, then you had uh, 1, 2, break, 3. Right, so you get the point, right? Oh, okay. It seems like we're not going to get it, so that's fine. Into our target though, it's okay. Right. So that's basically how you can identify institutional swing point. Now, see, after you identify an institutional swing point, right? That is when price will start to move. But that's the reason it's called institutional swing point, as authored by ICT, right? He calls it an institutional swing point because this is the signature in price action that you get right before price moves. It's the wrong one. So we have, this is what you get. So this is the next part of the swing low. This is the next part of the swing high, and that's where we enter. This is where we enter, right? So if you then look at all the reactions, fair value gap, OB, and everything, right? They are all basically essentially us getting in whenever the swing highs and lows are formed, and that is why we are able to get high risk reward, low risk reward, which your preference. This is how we're able to get these kind of trades. Okay, so how we're able to get this kind of trade. So now if we look at this trade here, right? So if you just have a look at this, now let's find the price. Let's see where I sold at. Okay, we sold at 1.21 416. Okay, now see. Okay. Right, so let's wait till I stop typing over here. You can see now here on the 5-minute time frame, we have 1, 1, 2, 3, and you see how it started to move from the third one, right? Started move from the third one. So basically over here, so we have uh, one, the down move from there was one, so one, two, and when it breaks down like that, we have another swing high forming here, three, and price comes back into this and drops further. Okay, just watch this execution and see what else you can see over here. And as price is going down, it's forming engineered swing highs, forming engineered swing lows, and all of that, right? And then I switched to dollar index because it was going to go down until we reached this spot. Afterwards, it will what do you call it? It's going to show some form of reversal and then fall down later on. Wait, are these pretty much intermediate highs and lows? Depends on the time frame. If you're looking at the 1 hour time frame, they are intermediate. 15-minute time frame and 5-minute time frame, they are short term, right? Short term. So, yeah. So basically, the point that I'm trying to drive to you guys is, we are always entering at the last point of the swing high, swing low. So basically, the point that price is going to print before it makes that expansion. Okay, now let's see over here how it goes. Okay, now see, you have this small high over here. So one, another one here, two, another one here, three, and then we move down, right? Then we move down. And the defining factor of whether it will go down or whether it will go up, right, is when we get a break in the middle swing highs low. I mean, if you get what I mean, if you have this, right? So if you look at this one here, when we get a break in the midpoint here, that is your confirmation that, okay, it's going to be a breaker. All right, so let's see. So it came down and then it stalled for a bit. All right, now keeping with the idea that this is now a swing high, right? Keeping with the idea that this is now a swing high, and from here, from this is the high, and then we break, right? That means from here to here, it's a breaker, and this over here is a clean order block with a liquidity void. Now you see, you have so many things going for you, right? So many things going for you, which you can easily identify. You have breaker, you have order block, you have liquidity void, breaking market structure. So when price comes back over here, we should see almost immediate sensitivity, which is why I did not take partials as well, because I knew it was going to come back in and just fall. That also, and also because this is yet to run through the high. Okay, so see the almost instant reaction, and take profit, almost about to get it. There you go. Okay, so he take profit as soon as this guy also went higher. Right, so that's the point to understand. That's the point to understand. The point to understand is this is exactly what's going to happen. Okay, this is exactly what's going to happen. And now if you look at the dollar index now, this is not a swing low, this is not a swing low, so there is no breaker over here that is of interest, so we can just see a small move and then a continuation higher. Okay, so and then if you apply that euro USD, now you can look at euro USD, it has come down, right? It has come down into what we spoke about earlier, right? But you can see that the reaction is not that instant. So what does that say about price? It says that in 5 minutes. In 5 minutes, we are about to get the news release. Okay, and we should see a run on liquidity uh, over here. We should see a run on liquidity over here. And if in case it is a significant shift in order flow, then this will just go up until this point, right? It will go up until this point and just drop again later on, basically next week, right? Now, if you apply everything that you learned today, or everything that led to a refresh of your concepts, and now if you look at the 4 hour, right? It's not loading, so let's just go to the 1 hour. Hold up, this is glitching. Why is it glitching? Oh no. Right, just give me a second. Right. Okay, is it okay? Yeah, it's okay now. Right, so if you go to the 1 hour now, we can see that here was the which one is the low. Now let's see which one is the low. This one, right? So we have a low here, low, 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 break in market structure. So then this area is of interest, right? Here, this areas of interest. But now we need to see. We now we can. We also need to see. Uh, what's the news event coming out? So we know that the news event is coming out in 10 o'clock. So in 3 minutes, 3 minutes, right? So let's look at how it reacts and see what happens. And the short term high was taken out perfectly. We have 5 minute chart swing high. So we have 1, 2, 3, right? This is number 3. So let's see how it reacts. Maybe it will go all the way up because of this. Okay. Right. So, anyways, is everyone okay with everything today? Like, if you have any questions regarding order flow only, because I'm going to keep it on record, right? Because now I basically gave everything that's on a need-to-know basis, like some stuff that won't confuse you, and stuff that's basically usable to make consistent profit every day. Okay, so if you have any questions, just do let me know right now regarding order flow, and we can discuss on record, so that if anyone else is missing today, they can refer to it. Yeah. So I'll wait for some questions. Let me check Discord. So is everyone okay? So if you all are okay, just put yes. If you all if you all need, if you all have questions, just type it out. What about the rest? You can now see news released. News has released, so we need to see how price is going to react. Let's see if it will hit my stop loss. I missed that trade though, damn it. Okay, let's see if I lose or win. It's after the session. Yeah, okay. I mean, yeah, it's pretty simple actually today. We looked at order flow and everything. Internal to external range, the highly probable scenarios, right? So if we mix all of that together, we get a solid, oh damn, I think we got stuck. Oh, okay. Yeah, so when we mix all of that together, we understand the bias, we understand the probable direction that price is going to go towards, and all of that, right? So that's pretty much it for today. So I kept it a bit simple. Like I believe the last time I had to show different things. So I kept it simple today. So it's your job to look at it on the charts, look at the formation of the breakers, institutional swing points, uh, and all of that, right? Because the institutional swing points, right, at the end of the institutional swing point. So because whether we know it or not, right? If you just go back and review all your trades, okay, you will see that most of your entry points came from here or near this part, right? Most of your entry points came from here and all of that, right? So this is basically how we enter. Now you see, so good thing that this is not a good reaction point, because now if you look at the dollar index, let me bring up the dollar index. Let me just make this a bit visual. Yeah. So again, like I said, dangerous spot. So I should have gotten it over here, but I missed it. But now it's a dangerous spot because of price coming here. Okay. So now this is an example. This is an example of how you can, sell that discount, buy at premium, by keeping your take profit very limited. So in this case, from here to here, 10 pips, right? It worked out, but I missed it. So trying again could be problematic. Looking at dollar index, seems like it's very problematic. Okay. Uh, where did you want to enter from? I wanted to enter from over here, right here. So let's see if this goes. If this goes well, then good. But mainly why over here? It's because if you look at it now, we had one, two, three. We had the break. So I wanted to get in somewhere here, which is the liquidity void responsible for the break. And so when it will most likely go to the order block, right? So I want to enter right here. But by the time I saw it, price was already here. So it was not worth it after. So yeah. But let's see. Since this liquidity void was responsible for the break over here, we should this should be an okay trade to come down to. If not, then it is what it is. And then you can see that we have one, two, and the third one should be somewhere here. Should be somewhere over there. Right. So, anyways, I'm done. Right. I hope it was okay for you all. Right. Sorry. This time I couldn't make it as detailed as the last time. It's because I have a lot going on right now. Let me stop recording first.